So in a recent video, I showed you how those who are self-employed can take advantage of the self-employed health insurance deduction. Well, in this video, I want to highlight something that anyone can take advantage of, whether you are a business owner or not. It's called the Health Savings Account, or an HSA for short, and it is literally one of the best, if not the best, tax advantage accounts available today. Now, there are some rules to be eligible, so be sure to watch until the end, and be sure to like this video so other people can benefit from it. Oh, by the way, subscribe if you don't want to miss future videos that can help you save and make money. Here's everything you need to know about an HSA and how to take advantage of their immediate tax savings. Let's talk HSAs. Hey everyone, Karan from Life Accounting here, where we help you save on taxes and increase your wealth. So, what is a health savings account? An HSA is like a dedicated savings account that provides you with tax advantages when you save for qualified medical expenses. And surprisingly, the list of qualified medical expenses that you can use your HSA account for is quite long, with a wide range of medical, dental, and mental health services that qualify, from contact lenses to first aid kits to physical therapy and surgery. So, what makes an HSA account so beneficial? Well, there are 3 huge benefits to using a health savings account that make an HSA a triple threat knockout. The first benefit is tax-free contributions. You heard that right. When you contribute to your HSA, you contribute money tax-free. And there are 2 ways to contribute. The first way to contribute to your HSA account tax-free is via your employer through a pre-tax payroll deduction, which means you can set money aside directly from your paycheck to go right into your HSA account and free of tax because it does not count as income. Now, if you're not employed or your employer's payroll system can't route to your HSA account, do not fear. The second way to contribute to your HSA account tax-free is by contributing to your HSA account personally. If you contribute personally, you can deduct those contributions during tax time and avoid paying taxes on those contributions. For the year 2021, the max annual HSA contribution you can make as an individual is $3,600 or $7,200 for a family. Be sure to not go over the limit or you will incur 6% tax on the additional funds over the limit. Oh, and contributions can come from more than just yourself. Your employer, a relative, or anyone else who wants to contribute to your HSA has the ability to do so. But wait, there's more. The second benefit of an HSA is tax-free growth. Typically, in a normal savings account, you earn interest on the money you put into the account. And the same is true for your HSA account. You put money in it and it earns interest. But where an HSA outshines a regular savings account is that interest earned in a typical savings account is counted as income and is therefore taxed as income. Well, the money that grows in your HSA grows completely tax-free. Can I get a hallelujah? The third benefit of an HSA account is tax-free withdrawals. So not only can you put money in tax-free, you can grow it tax-free and then withdraw it tax-free. Absolutely. This means you can pay for qualified medical expenses today and in the future out of your HSA account, completely tax-free. But the HSA is the gift that keeps on giving, because when you turn 65, the shackles of qualified medical expenses are lifted and you can use the money within your HSA account for literally whatever you want. You will have to pay ordinary income taxes on the funds you withdraw, but you also have the option to decide when you withdraw and can do so during a time when your income is low and you fall in a low tax bracket. But it's up to you. Now, there are a few different strategies you can use to maximize the benefits of your HSA. The first strategy is using it to pay for qualified healthcare. This is what most people use their HSA account for. It's called a health savings account. What else is there, right? I prefer to use my HSA as a retirement strategy to build wealth. That's because another benefit of an HSA is that the money you contribute can be invested in mutual funds, stocks, and other investments. So instead of using the money to save, I would use it to invest. I would make tax-free contributions, invest in an ETF like VOO, have that money grow tax-free, and then pull it out when I need it at 65. Do you see where I'm going with this? The HSA as an investment vehicle is literally one of the most tax-advantaged investment accounts there is. So you may be wondering, how do you pay for your medical expenses if you use your HSA to invest? Well, you pay for them out of pocket and reimburse yourself at a later time. You see, what most people don't know is your HSA will reimburse your medical expenses that you pay out of pocket. And best of all, you can reimburse yourself at literally any time. It doesn't matter if it's the next day, 10 years from now, 30 years from now, or after you retire. There is literally no deadline on reimbursement. This means you can keep the money you have in your HSA, increase the interest earned, and provide more time for your contributions to grow. Just keep the receipts. Even though receipts are not required to get reimbursed, you want to keep them in case of an IRS audit. Okay, so you know the benefits of an HSA and an amazing strategy to build wealth inside of your HSA if you choose. All right, let's talk about who is eligible for an HSA. There are 3 tests you have to pass to open an HSA. First, you need to be enrolled in a high deductible health plan, also known as a HDHP. You see, an HDHP is a plan that has a lower premium and a higher deductible. And for 2021, your high deductible health plan must have a minimum deductible of $1,400 for a single plan or $2,800 for a family plan. Additionally, your high deductible health plan must have a maximum annual out-of-pocket expense of $7,000 for a single plan and $14,000 for a family plan. The second test is that you are not enrolled in Medicare. Once you're enrolled in Medicare, you cannot continue to make contributions, but the money contributed can still grow tax-free. The third test is that you are at least 18 years old and no one can claim you on your tax return. If you meet all 3, you're eligible for a health savings account. Now, I want to talk to you about a HSA versus a FSA, because I don't want you to confuse an HSA with an FSA or a flexible spending account. You see, both an HSA and an FSA allow you to save for medical expenses, but they're different. I won't go into too much detail, but there are 3 things I want you to know. FSA contribution limits are lower than an HSA. FSA funds do not roll over to the next year, but an HSA funds do and never expire. And lastly, funds you contribute to an FSA cannot be invested, unlike an HSA, where funds you contribute can be invested in mutual funds, stocks, and other investments. All right, let's talk about setting up an HSA. Opening an HSA is quite easy, and there are a ton of providers called custodians. If you want to invest your HSA funds, just be sure that the custodian you choose allows for investing and also has low fees to do so. Hopefully you enjoyed this video. Be sure to give it a like so others can see it on YouTube, and subscribe to the channel for more videos that can help you save on taxes and grow your wealth. If you want more good information, I'm going to place a few videos on the screen that I think can help you. Check them out. And as always, I'm Karan from Life Accounting, and I'll see you in the next video.